You're listening to AI Prism from Seoul Economic Daily.
It's Thursday, June 4. Here's what investors are watching in Korea today. So imagine throwing a massive celebration, right? Because the stock market just hit an all-time record high. The champagne is popping. But when you look around the room, half the guests are getting their bank accounts forcibly wiped out.
Yeah, it's a completely brutal paradox.
Exactly. I mean, that's exactly what's playing out in Korea right now. In May, the hashtag KOSPI surged 28.4%, hitting a record 8,788. But at the same time, forced liquidations hit 707.7 billion won, or about $505 million.
Which is actually the highest wipeout of 2026, by the way.
Right. So how are investors getting completely crushed in what looks like a historic bull run?
Well, it really comes down to this hyper-aggressive retail strategy called Missouri trades. These are ultra short-term margin trades where you basically borrow cash from your brokerage to buy equities.
So you're placing a massive, highly leveraged bet.
Exactly. But there's a strict mechanical catch here. You have exactly 2 days to settle up. And if you don't score that account by day 3...
The broker just steps in.
Yeah, they automatically liquidate your position right at the opening bell. Like, no questions asked.
Wow, so it's a ticking time bomb. But, I mean, the market went up nearly 30%. So what actually triggered the explosion?
It was a very brief, sharp pullback. Like when the hashtag KOSPI momentarily dropped from 8,000 down to 7,493, retail investors who were maxed out on margin suddenly found themselves underwater.
Oh, and they couldn't cover that T+2 settlement.
Right, which triggered this brutal $505 million cascade of automatic sell-offs.
Okay, so the leverage blew up. But, this brings up a wild structural divergence. Well, the hashtag KOSPI hit that record high. The KOSDQ actually plummeted.
Right, the secondary market.
Yeah, Korea's secondary market for smaller tech and growth companies, basically their version of the NASDAQ, it dropped 146 points in just 5 days. So if the main market is roaring, why is the secondary market drowning?
Because the liquidity isn't actually broad at all. It's being entirely vacuumed up by something local traders call SAMG and Hynix. Yeah, it's market slang for leveraged ETFs tracking just 2 heavyweights, Samsung Electronics and SK Hynix.
Ah, I see.
So capital is hyper-concentrated in these specific semiconductor names. It's kind of like everyone in a casino crowding around a single VIP roulette table.
Leaving the rest of the casino completely empty.
Exactly. It's a ghost town, which actively starves the KOSDQ of liquidity.
Hold on, though. Retail traders crowding the roulette table is one thing, but what about institutional money? I mean, total retirement pension assets just crossed a staggering 500 trillion won, which is $357 billion.
That is a massive pool of capital.
Right, and ETF investments alone from that pool hit 48.7 trillion won, or $34.8 billion. Isn't that fire hose of cash enough to float the entire market, KOSDQ included?
Mechanically, no. And honestly, this is exactly why the Financial Services Commission is alarmed enough to hold an emergency meeting today on the KOSDQ's plunge.
Oh, wow, an emergency meeting today.
Yeah. Think about it. If you are a massive pension fund manager forced to safely deploy billions of dollars, you aren't allowed to just gamble on volatile small caps.
Sure, you need safety.
Right. But the deeper mechanical issue is valuation. So the KOSDQ's forward price-to-earnings ratio is sitting at a really steep 27.4 times.
Well, the hashtag KOSPI is what, much lower?
Just 8.0 times. It's a huge gap.
Ah, so you have this vastly more expensive secondary market right at the exact moment institutions are mechanically forced to hunt for safe, cheap bargains.
Exactly. That valuation gap forces all that massive pension money straight into the cheaper, large-cap hashtag KOSPI index funds. It just completely strands the KOSDQ.
That makes total sense, but it still leaves me with a massive contradiction. Brokerage stocks actually fell 4.34% in May.
Yeah, the decoupling.
Right. I need you to explain this decoupling, because standard market logic says if the main index surges 28%, brokerages should be making an absolute killing on trading fees.
You'd think so.
Yeah. So why on earth did their stocks fall?
Well, it goes back to that exact casino analogy we just used. Since the entire rally is exclusively concentrated in SAMG and Hynix, broad market turnover just hasn't materialized.
So high index levels aren't translating to widespread trading volume.
Exactly. Without that broad volume across thousands of stocks, the brokerages simply aren't generating the expected fee revenue. This is really the first true decoupling we've seen in 2026.
So this record-breaking rising tide isn't lifting all boats. It's really just lifting two massive semiconductor yachts.
Precisely. And, for you listening, here is the forward-looking risk metric you really need to watch. Total credit margin loan balances have swollen to 37.68 trillion won, or $26.9 billion.
That is a towering pile of leverage hanging over the market.
It really is. So before we sign off, ask yourself this. If a brief dip down to 7,493 wiped out $500 million, what happens if this heavily concentrated market stalls near 8,800?
A huge liquidation cascade.
Right. We could be standing on the precipice of a cascade that makes May look like a warm-up.
That's today's AI Prism, Markets Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Han I-Frey award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.